We will be speaking to the topic, Taxation and Economic Growth, Impact Assessment of Manufacturing Sector. And to chair this session, we have in our midst a partner with the PwC PricewaterhouseCoopers, Mr. Kenneth Erikume, FCTI. And to speak to this topic, we have the Director General, Manufacturer Association of Nigeria, because this actually impacts more on them, and we're speaking of the manufacturing sector in person of Mr. Segun Ajayi Kadri, M.A.N, ably represented by the Vice Chairman, Manufacturing Association of Nigeria, Abuja, Mr. Kayode Alonge. We have 4 discussants that will be speaking to this paper this morning, and it is my great pleasure to have up on stage the Director, Chief Executive Officer, Center for Promotion of Private Enterprise, CPPE, Dr. Muda, Yusuf. Also, as a discussant to today's topic, we have the Executive Chairman, Federal Inland Revenue Service, who is ably represented by the Coordinating Director, Mr. Matthew Gbonjubola, FCTR. Also, as part of the discussant, we have the Director General, National Association of Chambers of Commerce, Mines and Agriculture. That is NASIMA. Please, let's put it together for Mr. Sola Obadimu. And the last but not the least for our discussant on this topic is the first Vice President, Abuja Chambers of Commerce and Industry, the facility we are definitely occupying. Please help me make welcome to the stage Dr. Ekechukwu Chijioke, ACTI. On this note, I will be handing over to the chairman of session in coordinating this place for the next 1 hour, 30 minutes. Over to you, Kenneth Erikume. Thank you.
We're going to be looking at the important role of taxation for economic growth. As the MC rightly identified, manufacturing is one of the critical sectors of the Nigerian economy, and the impact of taxation on the manufacturing sector could either stimulate or inhibit, depending on how things come across. The MC did a quick introduction, but just to kick things off, I will call on the representative of the DG, Manufacturers Association of Nigeria, to take us through his paper presentation on this very topical issue. I want it to be very participatory, so let us take notes, let us be attentive. There'll be time for us to actually engage and get feedback and contribution. So without further ado, I will invite the representative of the DG, M.A.N, Mr. Kayode Alonge, to take the podium. Thank you very much.
The important topic before us this morning, taxation and economic growth, impact assessment of the manufacturing sector, is what this paper speaks to. And I'll try to go into it without wasting time so that there will be enough time to discuss. Taxation is a fiscal policy instrument government all over the world utilize to generate revenue for financing public expenditure on infrastructure development and essential public goods and service. An effective tax policy facilitates economic growth by efficiently redistributing income, improving the overall business environment, enhancing productivity, and developing human capital. In Europe, South Africa, Asia, Africa, North America, tax revenue respectively account for 46.4% in Europe, 23.5% in South America, 19.8% in Asia, 15.6% in Africa, and 11.1% in North America of GDP, indicating the global dependence on tax revenue for economic growth, according to Organization for Economic Cooperation and Development 2023. In Nigeria, tax revenue account for only 9.4% of GDP, according to IMF 2023, due to poor remittances, as well as complex and burdensome tax system that increase business compliance costs. Uncoordinated tax policy hinder economic growth by distorting market incentives, discouraging investment and reducing disposable income, high tax rates, reduce the after-tax return on investment, deterring capital formation, discouraging entrepreneurship, and diminishing tax base. Tax and economic growth. Let's look at the Nigeria scenario. The Nigerian government has undertaken various tax reforms to enhance efficiency, increase revenue, and foster economic growth. Reforms include integrated tax administration system, ITAS, for streamlined tax administration, establishment of tax appeal tribunal to resolve disputes, and recent establishment of a presidential committee for fiscal policy and tax reform. Despite significant increases in tax revenue, there exists a notable disparity between tax revenue growth and real GDP growth in Nigeria. Factors such as corruption and systemic issues necessitate further examination and reform of a tax system. Now, there is a chart here, tax revenue growth versus real GDP. If you can see from the screen, you will see the relationship between the two. Despite the fact that the burden of tax revenue has continued to increase, we see that the impact on the real GDP growth has not really met the desired goal. Therefore, we look at tax revenue recorded 59% rapid growth from 6.9 trillion in 2021 to 10.18 trillion in 2022. However, real GDP has remained stunted, hovering around 2 to 3% in most of the period, as we can see. This disparity is attributed to widespread corruption and poor implementation of development program. Manufacturing transforms raw materials into high-value added finished products, contributing to economic growth and development. The sector reduces imports and stimulates economic growth by increasing preference for locally made goods. And this is what M.A.N has championed over the years, for the past 50 years, over the past 50 years. Exporting manufactured goods reduces dependence on oil revenues and increases foreign exchange earnings. Manufacturing stimulates growth in mining, agriculture, and other allied industries. Manufacturing enhances profitability, increases tax revenue, deepens economic diversification and active participation in the global market. Economies with strong and diversified manufacturing bases experience higher rate of economic growth and development, as witnessed in East Asian economies like China, South Korea, and Taiwan. By leveraging the manufacturing sector, Nigeria can reduce its reliance on oil exports, create employment opportunities, fight inflation, foster technological advancements. Undoubtedly, there exists a causal relationship between manufacturing output and economic growth, as a duo can serve as drivers of employment, income, consumer expenditure, export earnings, innovation, and technological advancement. We can see on the screen that despite the numerous potentials of the manufacturing sector, its contribution to the economy continues to hover around 9% since 2013. This is partly due to heavy taxation of the operators within the sector. We will really want this trajectory to change significantly going forward. Tax policies and regulation play a crucial role in determining the sector's profitability and growth prospects. The manufacturing sector is subject to various forms of taxation, shaping business environment and influencing investment decisions. In Nigeria, the manufacturing sector faces a range of taxes, including company income tax, CIT, value-added tax, VAT, withholding tax, import duties, to mention but a few. The corporate income tax rate for manufacturing companies in Nigeria is relatively high, between 20 to 30% compared to other African countries, according to Deloitte 2022. Additionally, the sector is subject to a 7.5% VAT on goods and services, and various withholding taxes on dividends, interest, and other payments. The manufacturing sector makes the highest contribution to tax revenue in Nigeria, contributing 27.5% to VAT and 24.9% to CIT, according to FIRS 2023. Like we can see on the screen, that at the top of the chart there is the manufacturing sector, followed by ICT, mining and quarrying, finance and insurance, and of course public admin, defense, and compulsory social security. Also, we can see the charts showing the contributions to the CIT revenue. Manufacturing is also still at the top of the chart. This is according to FIRS and NBS, National Bureau of Statistics. Let's look at the overview of the Nigerian tax system. Nigerian tax system has evolved from traditional forms of taxation to a modern structural framework. It traces back to the 18th century when traditional rulers and local authority collected funds for development projects. The modern tax system foundations were laid in 1904 with the introduction of personal income tax, initially called communities tax. Since then, Nigerian tax system has continually evolved, focusing on modernization, expansion, and reform. The country operates a three-tier system of government, aligning with its federal structure, ensuring clear division of tax powers among the federal, state, and local government. This framework promotes effective tax administration and fiscal management nationwide. The tax landscape in Nigeria, we can see the company income tax, the value-added tax, custom duties, capital gains tax, excise duties, consumption taxes, property taxes, vehicle registration fees, and so many others that this paper cannot contain. There are a lot of challenges, and of course, we'd like to talk about some of the challenges of multiple taxation. Taxes from federal, state, and local level impact manufacturing, exacerbating challenges and hindering development and competitiveness. Increased taxation for internally generated revenue leads to heavier tax burdens than anticipated, impacting manufacturers' profitability and competitiveness. Imposition of overlapping taxes create compliance burden, operational inefficiency, and reduced profitability for manufacturers. Duplication of taxes increases production costs and final prices of goods and services, eroding profit margins and hindering investment incentives. Now, M.A.N survey conducted in 2023 reveals numerous taxes with overlapping effects, adding complexity and burden to businesses. Sales tax and value-added tax, mobile advertising charges, education levies, tenement rates, land use charges, and parking fees contribute to financial burdens for manufacturers. Multiple taxation discourages investment, stifles entrepreneurship, and hampers economic growth, affecting SMEs disproportionately. Coordination among government levels is needed to harmonize tax policies, streamline administration, and simplify the tax payment process for manufacturers. This could involve the use of technology, such as online tax portals, to facilitate easier and more efficient tax compliance. Recent tax development and implications for manufacturing sectors. Recent changes in the Finance Act aimed to increase tax revenue have negatively impacted the manufacturing sectors. Examples include the increase in VAT from 5 to 7.5% in 2020, and the rise in the tertiary education tax TET rate from 2.5% to 3%. In 2023, there were approvals for increases in import taxes, excise duty on non-alcoholic beverages and tobacco, and the introduction of new taxes on single-use plastics and specific motor vehicles. These reforms contradict the guiding principle of the National Tax Policy, NTP, which emphasizes certainty, long-term consistency, and stakeholders' engagement. The recent tax reform also lacked smooth transition periods, transparent incentives, and measures to reduce the number of taxes and prevent multiple taxations. These reforms have significantly contributed to the underperformance of the manufacturing sector, particularly affecting domestic sales and employment generation and export. Recent tax reform has adversely affected manufacturing sales performance in the domestic market. The value of unsold finished goods surged by 220% from 271.96 billion in first half of 2023 to 869.37 billion in second half of 2023 due to these tax reforms. This tax reform has also contributed to high inflation exceeding 30% and diminished competitiveness in the global market. Specifically, the share of the manufacturing export to non-oil export decreased from 82.4% in 2019 to 24.8% in 2023, indicating a significant decline in competitiveness, according to MBS 2023. This is a great concern to the manufacturing sector. Nigerian manufacturers' competitiveness in the global trading environment has declined due to the multitude of taxes. This tax burden may hinder the sector from maximizing potential gains in the African continental free trade after. Manufacturing SMEs face significant erosion of income, with over 10% being lost annually. More than 30 different taxes, levies, and fees contribute to this erosion of income, according to M.A.N survey in 2023. Now let's look at some selected taxes and impact assessment of the manufacturing sector. If you look at the figure and the chart here, Figure 1 reveals that between 2013 and 2017, that's 4 years, average values of VAT revenue and unsold manufacturing goods stood at 138.78 billion and 125.67 billion respectively. However, between 2018 and 2022, another 4 years, the average values are both increased to 273.35 billion, that's about 100%, and 441.88 billion, that's about 250% respectively. This suggests an upward trend in both the value of VAT revenue collection and unsold manufactured goods. Now, if we look at the chart, we'll see the relationship between, the VAT revenue from the manufacturing sector and the unsold inventory. And of course, it is also a disturbing trend because this is not good for our economy. So, between 2013 and 2022, rising value of unsold inventory has been associated with increases in VAT revenue collection, as higher VAT collection had dampened the purchasing power of consumers through increased prices of goods. Figure 2 reveals that between 2015 and 2018, average values of CIT revenue, manufacturing capacity utilization, and manufacturing share of non-oil exports stood at 126.67 billion, 56.85%, and 49.95% respectively. Also, between 2019 and 2022, the average values of CIT revenue and manufacturing share of the non-oil export increased to 263.74 billion and 56.48% respectively. However, the average value of manufacturing capacity dropped to 56.2%. This suggests that CIT revenue followed a clearly upward trend. Manufacturing share of non-export followed a weak upward trend, while manufacturing capacity utilization recorded a fairly downward trend, as we can see from the screen. So since 2019, increase in CIT revenue collection has been associated with sharp decline in manufacturing share of non-oil export, as well as a gradual decline in manufacturing capacity utilization. It gives a clear indication of the adverse impact of high CIT rate on operational cost and global competitiveness of Nigerian manufacturers. If we look at the table, selected taxes and impact assessment of the manufacturing sector, so there's a table showing Pearson pairwise correlation. Now, this table, so the negative signs implies a further increase in VAT and CIT revenue through higher rates will result in decline in manufacturing capacity utilization and manufacturing share of non-oil export. On the other hand, the positive sign implying that further increase in VAT and CIT revenue through higher rates will result in rise in the unsold inventory of manufactured goods, just like the table as clearly shown. Emphasis on the red portion of the table. With focus on the red cell, So higher VAT revenue collection has 70% link with a fall in capacity utilization. Higher VAT revenue collection has 55% link with a rise in value of unsold inventory. Higher VAT revenue collection has 52% link with fall in manufacturing share of non-oil export. Higher CIT revenue collection has 16% link with fall in capacity utilization. Higher CIT revenue collection has 51% link with a rise in value of unsold inventory. Higher CIT revenue collection has 50% link with fall in manufacturing share of non-oil export. The next table, ordinary least squares, also speaks to the relationship between these factors we are considering. And so if you look at the outcome of the analysis, it shows that the manufacturing sector has been adversely impacted by the imposition of high taxes and failure of the government to reimburse the sector with adequate tax incentives from revenue collected. So by intuition, the government has generated significant increase in VAT revenue at the detriment of consumers' purchasing power and economic welfare. This is also not acceptable. In other words, the rapid rise in the value of unsold manufactured goods is a reflection of a dwindling sales performance in the sector. The inflationary impact of the increase in VAT rate from 5% to 7.5% partially contributed to the erosion of the consumer's purchasing power and the eventual rise in the value of unsold inventory. Now, a percentage increase in VAT increases value of unsold inventory by 1.58%. A percentage increase in CIT reduces manufacturing capacity utilization by 0.82 percentage point. A percentage increase in CIT increased value of unsold inventory by 0.93%. A percentage increase in CIT reduces share of manufacturing export by 14.21 percentage point. The effect on CU and the exports of the non-oil exports of the manufacturing sector are insignificant due to the other major factors not in the model, such as high energy prices, high interest rate, unstable exchange rates, and forest scarcity. Let's look at a comparative analysis. If we look at countries that are doing well in manufacturing, take for instance, China, we see the manufacturing export value according to WTO and World Bank between 2015 and 2022. And of course, as we can see a steady rise. The growth is just steady there. Now, what is, responsible for this? It is nothing but tax incentives that is very deliberate. So we look at tax incentives, boosting Chinese manufacturing sector. For instance, there's a 5-year VAT exemption for small tax payers. Small taxpayers, maximum 5-year reduction in employment security fund payment for people with disabilities. Manufacturing SMEs and individually owned businesses enjoy over 50% reduction in stamp duty, resource tax, real estate tax, urban maintenance, and construction tax, urban land use tax, and cultivated land occupation tax. There's also a 50% reduction in education surcharge and local education sectors. Reduction in the company income tax rate from 25% to 15% for manufacturers operating in free trade zone. VAT reduction policy, application for a one-off refund of accrued deferred tax credit, gradual reduction of the unemployment insurance premium rate to 1% till December 31, 2024. These are very deliberate, they are very intentional. And the government of Nigeria must also take a cue if we really want to change the narrative in our manufacturing sectors. Now, over 13 billion rand, this is for South Africa now, manufacturing sector. Let's look at the data. We also see the growth in the manufacturing sector from 2015 to 2022. For instance, over 13 billion rand on tax-intensive, to encourage manufacturing investment in revenue energy projects. Tax expenditure is in the form of a reduction in corporate tax by 125% of the cost of revenue energy investment. Also, tax incentive for installation of solar panels in order to ease industrial pressure on national grid. Equivalent to 25% of the cost of solar panel. That's what people are made to enjoy, and that's also very deliberate. So in Nigeria, let's look at our own situation here. We can see the chart according to WTO and World Bank. Unfortunately, in Nigeria, the manufacturing sector have been the least competitive compared to Chinese and South Africa export due to high taxation, exorbitant exchange rate, high interest rate, and inadequate government support. You can see the chart over there is speaking to it, and that's not also good for us at all. The average value of Chinese and South Africa manufacturing export are respectively over 823 times and 13 times greater than the average value of Nigerian manufacturing export between 2015 and 2022. What are the lessons for Nigeria? One, it is high time the Nigerian government salvaged the manufacturing sector by taking cues from the Chinese and South African government, who in recognition of industrial development role of manufacturer provided them with adequate incentive to excel in the global market. For instance, Nigerian manufacturers are currently charged a CIT rate of 30%, which is higher than the global average of 23.45%. In China, the standard CIT rate is 25%. Interestingly, qualified Chinese manufacturers could have their CIT rate reduced to as low as 15%. In South Africa, standard rate was formerly 28%, but now it's 27%. In emulation of the cases of China and South Africa, the Nigerian government commitment to industrialize the economy must be reflected by its provision of adequate incentives to the manufacturers, who are undoubtedly the propellers of the industrialization agenda. It is pertinent to urgently review some of the tax policies that have placed Nigerian manufacturers in a disadvantaged position among their peers. The current tax regime contradicts the national tax policies, which place less emphasis on direct taxation to incentivize investment. Conclusion and recommendations. Several number of Nigerian manufacturers are struggling for survival considering the rising cost of doing business in the country. The indiscriminate multiple taxes, fees, and levies continue to undermine the performance of manufacturing sector, and in extreme cases have resulted in the liquidation of many manufacturers within the SMI cadre. The tax challenges encroach massively into their financial gains, leaving many with no option than to stay out of business. In order to reposition the manufacturing sector as a driver of a rapid, sustainable economic growth that is needed to advance the economy as one of the 20 most industrialized economies in the world, the government must strive, among other numerous challenges, to address the harsh tax laws bedeviling the sector. It is a hope of the Manufacturers Association of Nigeria that the government will, among others, ensure the filing of tax identification number, CITN, and tax return in order to block leakages of multiple taxation and properly document their accounting record daily. Carry out a comprehensive review of relevant statutory requirements, legal and policy framework in order to create an enabling business environment for businesses. Engage the stakeholders in the amendment of outdated tax law and appropriately harmonize taxes to eradicate the multiplicity of taxes. Check the excessive of non-state actors who impose non-statutory tax burden on manufacturers. This has been a great nightmare for many manufacturers, thereby causing them huge losses. genuinely renew the social contract with the taxpayer, and intensify mechanism for accountability in order to encourage tax compliance and utilize tax revenue for the growth of the manufacturing sector and the economy at large. Promote a value system that improves revenue administration, enhances transparency in revenue reporting, and ensures prudency in public spending for the progress of the manufacturing sector and development of the economy. Engage all relevant stakeholders, including regulatory and professional bodies, such as CITN, in order to devise modern solutions to tax-related problems. Increase taxes on numerous goods instead of a productive sector to avoid a negative impact on the economy. Reduce corporate tax rate in view of the numerous challenges experienced by manufacturers. Exempt VAT on raw materials used to produce non-vatable finished products. Suspend the implementation of a minimum tax in view of the prevailing economic challenges being faced by virtually all operators. Further widen the tax net and enhance efficiency in tax administration through the adoption of technology. Fast-track the implementation of the recommendations put forward by the Presidential Fiscal Policy and Tax Reforms Committee. Fast-track the implementation of a VAT direct initiative to transit operators in the informal sector to the formal sector. Ensure synergy among tax authorities and other stakeholders, such as the National Union of Road Transport Workers, NURTW, and the Market Traders Association of Nigeria, M.A.N, to facilitate the harmonization of taxes, levies, and fees, reduce the incidences of illegal tax collection to the barest minimum. Lastly, develop mechanisms to monitor the activities of state internal revenue services to ensure that taxes are not collected outside their jurisdiction. Ladies and gentlemen, thank you so much for listening.
Thank you very much, Mr. Alonge, for that very detailed presentation. I'm sure some of you would have seen those recommendations before. So maybe 10 years ago, those recommendations were already mentioned. The question for us is, what is actually holding us back from doing some of these things? You know? But so that I do not take over the microphone, I would like our discussants to actually contribute to this very topical issue. And I'll be giving each person 7 minutes because of time, because we would want to get feedback from the audience as well. So the first person I would call is Dr. Chijioke Ekechukwu to give us his perspective around the paper.
Well, it is no longer news that our tax efficiency level is still suboptimal. With a tax to GDP ratio of 10.6, but I know that the last speaker mentioned 9.4 according to IMF, but we have to deal with what we have locally, which is 10.6 according to MBS, as at the end of 2023. But it's a significant growth, however, from 6.7 in 2021. So I think we'll have to give kudos to FIRS. We are on the 35th position in Africa regarding tax to GDP ratio. So now we wonder, is our tax rate low? Is our GDP very high? Why are our collections low? What are we doing wrongly? Now, if the largest economy, or one of the largest, because now the largest position is being questioned, if one of the largest economies in Africa is around the 35th position in Africa, not the world, then that means we need to improve on a lot of things that are happening. So, is our tax rate low? In my opinion, No. In my opinion, no. The opinion of FIRS may be different, but my opinion says no. The reason I say this is that I'm sure we know that countries that will consider our contemporaries because they are other oil-producing nations. Countries like United Arab Emirates, where we have Dubai, Qatar, Kuwait, and Oman. These countries have zero tax on CIT, PAYE, and all those ones that involve individuals. But they make their money from taxing oil manufacturing or oil producing companies in that same country. So if you're an oil producing company, they tax you about 55% of whatever income you have made. In other words, once you declare your income, the country from taxes will take about 55%. For other companies that are into construction, you know, those countries are doing a lot of construction, they also charge them all those taxes. And if you are into some other things, construction, you are into mining, those are the people they charge. But for the companies, manufacturers, zero. And that is it. So these are some of the things we can look at. If people are ready to do oil in Nigeria, we can tax them as much as we can do because, like I said, these are our contemporaries. Is our GDP very high? You and I know that our GDP is not so high, and so we cannot say it's because, you know, you are comparing tax to GDP ratio. So if we are not doing well in tax to GDP ratio, that means it is possible our GDP is high, but we all know it is not high. So why our collection slow? Those are the things we are going to interrogate as we move on. What are we doing wrongly? We can also look at that as we move on. So, I know the Presidential Task Force on tax reforms and fiscal policy improvement have called some people who are low. They have called them informal sector. But I have another definition of informal sector. Because he already said that informal sector, 95% of informal sector people are not supposed to pay taxes. So this is my own definition of informal sector. The amount of money we have from this informal sector, you cannot imagine. The bloggers, they are all billionaires. I'm sure we all agree. The skit makers, the content creators all over Nigeria, they are the people ruling this economy today. The influencers, the online marketers, agents of all kinds, royalty collectors, the musicians that receive billions for people listening to their music, and many others like that. These are the people I consider informal sector, not those ones that will not pay taxes. These ones, we must bring them into the tax net or tax basket or tax basin, anyone we want to bring them into. So we also need to expand the tax net in the formal sector and the self-employed high net worth individuals. There are so many people in this category, I don't know how we're going to capture them. I do not know how we're going to capture them. We need to capture them because a lot of monies move from one place to another. And you know, people have ways of circumventing certain payments. And so pay it into my personal account, and he collects it. He declares his income as just peanuts, but he has collected billions for jobs done. So we need to look at those ones and play low on manufacturers. Okay, we need to increase productivity. You know, if you have 10 factories here today, we used to have a lot of them in Kaduna in those days and other places. If we have 10 factories, we will collect taxes from 10 different factories, CIT, PAYE, VAT, excise duty, and all those things. There are many of them we'll collect. But where the income that should have come from 10 different factories is eroded, then you see that that is the reason why we're not doing well. There are so many things we need to do as government. We can create industrial parks. and have many people share the facilities. We need to have enough database because probably one of the reasons we have today is database that we do not have around everything happening. There are leakages. We need to improve on our institutions. The institutions are weak. We need to block corrupt leakages in terms of collections. Then I know that for us to improve on our performance, we need to increase the tech deployment into collections and seeing what people are doing and having that collection done. Okay, so we need to also consolidate collections. But there is one I call the manufacturer's albatross. Manufacturer's albatross, I'm not only talking about the ones coming from federal. The problems people have actually come from municipals or local government areas. So on the screen, I don't know if you're seeing that, I have all the ones from federal. They will sort it out on how to consolidate them. But I had to get a certain, we've talked about multiple taxation. That's why I'm not trying to use it, those words, because we're used to hearing them. In my own office, we have received from the municipal, that is AMAC, radio license fee notification, tenement rate. In my office, I'm not talking about what I read in my office. Radio license, radio and TV license, tenement rate, business permit, environmental levy, inspection and certification of habitable properties, sanitary levy, operational permit, mobile advert, signpost levy, waste management, and many more. So we need to, if we say, put these things together, these are the problems, not just the federal ones. So in my conclusion, I said, we need to be intentional about what we need to achieve and what we need to trade off. We cannot approbate and reprobate. If we want to build this economy and build our taxes, we cannot be doing things that will also reduce the collections. Every economy relies on its real sector, which is manufacturing sector, for growth. If we want manufacturers to breathe, we need to give them oxygen. Enough oxygen for that matter, so that the economy could live a healthy life. Thank you very much.
Thank you very much, Dr. Chijioke. The next contribution to the paper, I will call on Dr. Muda Yusuf. Just to say that apart from tax, there are other things that government needs to look at. It has to be a comprehensive strategy. And the manufacturing sector is facing significant headwinds in terms of inflation, in terms of interest rates and things like that. And some of them are closing shop. So the comprehensive economic strategy to deal with this. Over to you, Dr. Muda.
Thank you very much. First, I must commend the paper presented by Manufacturers Association. Very comprehensive and very well researched. And it has covered practically everything. Just for me to emphasize that the government had been extremely very bullish about revenue generation. And I just want to caution that we need to balance revenue objective with growth objective. Because if we don't grow the economy, ultimately revenue will be adversely affected. And we need to grow the economy to create jobs, to reduce poverty, and all of that. So while it is good to raise revenue, we need also to ensure that we pay equal and very important attention to issues of growth. And the manufacturing sector is a major driver of economic growth. So we need to take it easy and slowly for them. Just as the lead paper presenter said, they are grappling with high energy costs because manufacturing is energy intensive. And if there are any sectors that are facing serious challenges today, are sectors that are energy intensive and sectors that are foreign exchange intensive. Those are the biggest casualties of the economy today. So we need to recognize them and see how we can create an environment for them to be sustainable. They are grappling with huge energy costs, huge logistics costs, supply chain challenges, forex volatility, customs duty exchange rates. I cannot emphasize this enough. And please, the chairman of FRS, if you can also help us to convey this. This is a major problem for manufacturers and indeed all investors. Yes, we don't want to take any steps that will undermine the current reforms. So investors are ready to deal with the volatility in the foreign exchange market. We are hoping that with time, these things will stabilize. But we cannot be grappling with volatility in the foreign exchange part of the economy and be grappling with volatility in trade. That is double jeopardy. This month alone, we have changed the exchange rate for computation of import duty by close to 10 times. How do you plan for the importation of raw materials? How do you plan the importation of your equipment? And so many other things. So please, Chairman FRS, if you can help us to escalate this matter. It's a very, very serious issue. We are not saying that we should allocate foreign exchange at different rates to different people. No. What we are saying that in the interest of stability of trade, international trade, investors' confidence, please let's do something about this customs duty exchange rate so that we can have predictability. And we can also even reduce costs. The government is worried about inflation. They are worried about unemployment. We need to reduce costs. And one of the easiest ways to deal with this is to see what we can do around trade. So I just think I need to emphasize. So because of all of this, of course, you have high cost of fund and all of that. I'm saying this to underscore the point that the manufacturing sector needs some empathy in this economy. And that is why many investors are now migrating to services sector. The economy now is about 57% services. Because if you are in the service sector, you don't need a 100 kVA generator. You don't need to be clearing containers from the ports and be grappling with all sorts of issues. You know? So please, we need to take that into account. And just as I said, if the economy grows, revenue will grow. It may be a catch-22 situation. Which one comes first? Is it revenue or growth? But my belief is that if we do everything that we need to do to grow the economy, ultimately we'll have an improvement in revenue. And in addition to that, we will have been able to build an economy that is inclusive, that will be able to reduce poverty and create employment. Investment in treasury bills doesn't create jobs. Investment in bonds doesn't create jobs. People just write checks, get money, invest, get their, and even for some of those investments, they're even completely exempted from tax. What is their value to economic growth? Almost zero. So please, we need to do it in a way that we create an incentive regime that will help to get more investors into the manufacturing sector. And of course, let me also quickly talk about this tax to GDP ratio. We have to be careful in just adopting some templates that are used elsewhere. This tax to GDP ratio thing, we need to interrogate it. This principle assumes that there is a correlation between GDP and tax revenue, which is not correct. About 40% of our GDP don't generate any significant revenue. How much revenue are we getting from agriculture? Many of them are peasant farmers. Agri accounts for about 26% of GDP. The revenue there is almost zero. Are you going to be taxing the peasant farmers or the cattle rearers? Of course not. The distributive trade accounts for about 16% of GDP. Many of them are informal sector traders. How much revenue can you get from them? Almost nil. So you already have 40% of GDP out that are not contributing to revenue. So when you begin to use this ratio, sometimes you can lead us to wrong conclusions. So what we have is just about 60% of the economy that are carrying the burden of tax from the GDP point of view. So we need to interrogate that, and we also need to capture properly the taxes that we are paying. Apart from the VAT, company tax, tertiary education tax, stamp duty, NIDA, NASENI tax, we also heard that NYC tax is on the way, tertiary tax is on the way. Then all the regulatory agencies have become revenue-generating agencies. That is the reality. We may not call them tax, but it's still something that is coming from the pockets of investors. Then you have on top of that the state taxes, local government taxes, and you have the area boys who are also collecting some significant amount of taxes. That is, of course, not recorded. So please, don't let us mislead our policymakers so that we don't give the impression that we are not paying enough tax. We are paying enough tax. I admit that we need to improve on the administration, the efficiency, which the government is already doing, and we are beginning to see some results around that. And for some organizations, particularly in manufacturing, there is a concept of implicit taxation. When you set up a factory and you are the one providing the roads to your factory, you are providing security, you have to provide your water, you provide electricity, you do all sorts of things, which ordinarily the state should have provided. That is also a form of tax, which we don't reckon with. So please, I'm just saying this for us to be able to understand the context in which our investors are operating, so that we arrive at the right kind of conclusion as to the status of tax and the burden of taxation. Thank you very much.
Excellent. I think when you mentioned what are we doing in terms of agri and the lack of revenue from that space, I think it's a nice segue to bring in the only other mister on this podium. I think the other people are doctors. Okay, doctor, are you Dr. Gbonjubola? Okay, you're mister, so we are three misters. So I will invite Mr. Sola Obadimu to speak about, the paper and the context of agri and mines and the manufacturing industry generally. Let's put our hands together for him.
It's nice to be here today, and I dare say this has, as usual, been an outstanding, successful conference by CITN. And the topic we are discussing today is so important. And a lot has been said by the lead paper. Again, acknowledged so as very comprehensive. There is no need to repeat anything that has been said. Also, two of the panelists, they've spoken. Incisive issues have been raised, things we need to ponder on. But I am basically a management scholar. And I know in the olden days, there used to be something like MBO, Management by Objectives, by one man named Peter Drucker. Now, for example, I came from Lagos. Before the pilot took off, there was a flight plan which he knew where he was going before going through the procedures involved in taking off. He didn't just take off, and then getting into the skies, he tries to find out where Abuja will be through his compass. Running a national economy is a serious business. Trying to achieve certain goals within the economy is a very serious business. What do we want? Do we want to grow businesses? Do we want to grow the manufacturing sector in particular? If we want to grow the manufacturing sector in particular, we should tailor our minds to some things. What do we want? How do we want to achieve that? We are a huge nation, huge in population, I think they say 1 in every 4 Africans is in Nigeria. Why can't we reach our potential by being the biggest manufacturing hub in Africa? Of course, you can't run that. You can't achieve that running a nation on generators. You can never achieve that. Churning out an electricity capacity of 3,000 megawatts, I think. It has been like that since the days of Mr. Mongo Park, and it has never changed significantly. Now, I think for us to be called a truly industrialized nation, we need to be talking about something close to 150,000 megawatts. Are we doing anything to achieve that? The last panelist spoke about the chicken and the egg or whatever, who comes first. Is it not better to achieve growth and be sure of making more money? I think that's a deeper insight to it. Let us expand our mind. Look at, there are 2 primary areas, industrial areas, the agric and the mining sectors. In manufacturing or processing, you have to start from any of these 2. We are exporting basically raw materials from both ends, from both these sectors. We are not adding enough value. The larger objective of manufacturing is to be able to be a significant exporter. We could have set up our mind and achieve something like the biggest exporter of goods and services on this continent of Africa. That is how we can realize the gains of manufacturing. But as it is, we are trying to make fast gains today without thinking of longer-term possibilities. I think that is where we need to take a second look at. And there is a conscious effort to make current taxpayers pay more rather than widen the base. Like I said, if the agri-sector, for instance, if we make it more efficient, just as we are trying to make tax collection efficient right now, if we create a situation where the whole agri value chain, we make it more efficient productively, whereby we maximize the gains from that sector through preservations, through, so that we don't just have oranges 2 months in a year, pineapples 3 months in a year, bananas 4 months in a year. Even in South Africa, you can get all fruits all year round. But like I said, you can't do that on 3,000 megawatts. So the same thing goes for the mineral sector. We are not optimizing enough from that sector. We are not beneficiating the raw materials. People are coming in and taking these things out. And a lot of taxes can be realized from that sector if it is formally organized, if we allow people to come in, process these mineral resources. It will also give us an opportunity to employ more people, and of course, taxes will come in. The same thing, like I said, applies to the agri sector. We are not doing enough. Agri can employ far more if we optimize that, the potentials of that sector. And of course, the more players that are in that sector, the more taxes that will come in. Unfortunately, some multinationals, we understand, are thinking of leaving the country because of the challenges that we have. I think we need everybody. We need the local players, we need multinationals, and of course, we need to make sure that our people are also investing in this economy. We need to be sure that people are showing confidence in this economy. If our people that have the means are taking their monies out, we shouldn't expect foreigners to be bringing their monies in. Charity, they say, begins at home. I think we should take a look at our global objectives so that whatever policies we have, including tax policies, can key into our global national objectives so that we can be where we want to be when we want to be. And those timelines, those clear goals should be spelled out so that the Nigerians as a whole can understand where we are going and how we want to get there. It's a pity politicians coming in on a 4-year term tenors, but I hope, I pray, we could get to a point where our clear goals will be cast in such a way that all these 4-year short-term tenors will not affect our longer-term goals. Thank you all for listening to me.
Excellent. Let's put our hands together and appreciate him a bit better. He actually stuck to time and was speaking extempore. I think the next person to speak, we've all been waiting for FRS to speak on this subject matter. They say that government is the biggest shareholder in business. So if you look at the 30% CIT, the tertiary education tax of 3%, which is not on profit, by the way, it's on pre-depreciation profit. Then you look at police trust fund and other things. Government is obviously taking the biggest chunk before other shareholders. So how can we collaborate to ensure that this industry thrives? So Mr. Gbonjubola, Matthew Gbonjubola will be representing the executive chairman of the FRS on this matter. Thank you.
I think the topic we are discussing is very important, particularly to the economic growth of our country. And all the myriad of challenges facing manufacturers, as enunciated by previous speakers, cannot be faulted. Manufacturers, just like every other business in Nigeria, face problems with power, road infrastructure, water, security, and all of that. And that is true. It is also true that because the government is trying to correct the imbalance in the economic policies of the past, issues around foreign exchange access has come in, issues with getting fuel to power machines have come in. That is true. Now, there had been issues around overtaxation or multiplicity of taxes. Maybe partly true, maybe not true. There had been discussions as to the CIT rates, VAT rates in Nigeria. I think that is debatable. Because if you look at CIT, for example, the average CIT rate in Africa is about 28%. Some are above 30, some are below 30. If you look at VAT rates, the average in Africa is 16%. The average in East Africa is 15%. The average in South Africa is 15%. The average in West Africa is 16%. The VAT rate in Nigeria is 7.5%. And I'm glad that the first speaker gave us the tax to GDP ratio in the OECD country, which is about 46%. But we also know that average VAT rate in OECD countries above 20%. What I'm driving at is it's not the headline tax rates that is the issue with manufacturing in Nigeria. Our problem are more of our infrastructure, are more of our markets, are more of insecurity that makes it difficult for us to operate freely. But then, when we look at the issue of tax to GDP ratio in Nigeria, the question had been raised, if we have the largest GDP in Africa, how come we have one of the least? I think we are second lowest tax to GDP ratio in Africa. And the answer had been provided by one of the speakers. The agricultural sector, the service sector, and mining sector combined to make about 70% of our GDP. And the revenue, tax revenue from those sectors are very close to zero. And the reason, very clear. Because we operate a federal fiscal regime where the government via the FRS is responsible for managing taxes with corporate businesses, and the 37 state IRS, and I've added Abuja to make it 37, manage the taxes of individuals. And if you look at if you have had opportunity to see the report of SARS, that's South African Revenue Service, you will realize that the bulk of their collection come from personal income tax, not from corporate tax. If you go to Europe, the OECD country that we refer to, the constitution of their tax revenue is about 60-40, 60 from personal income tax and 40 from corporate income tax. And so when we talk about efficiency of tax administration, I believe FRS is not 100% there, but I think we are much, much above average. We understand that manufacturers have faced with different kinds of levies and taxes. But then, let's take a look. How many of these taxes are federal taxes? They are taxes that are imposed sometimes outside of the tax laws. I think those are the issues we should speak to. And then, question is, what can we do better? And before we get there, let's look at what we are doing currently in the Federal Inland Revenue Service. For the past 4 years or thereabouts, the Federal Inland Revenue Service have embarked on simplifying the tax rules to make it easier by way of the various finance acts that has been enacted since 2019. The skills of our officers all over the country are constantly being improved. And I'm glad I am among tax practitioners who relate with our tax officers from time to time. And I'm sure there are testimonies that our officers are getting better by the day. In 2020, the FRS took a strategic decision to move on to technology, and we came up with the Tax Pro Max, which made it possible for taxpayers to file returns without having to come to our offices. Now you can generate, and you are generating your tax clearance certificate without having to fill any form and come to the FRS service. You are able to pay your taxes anywhere you are in the world without having to go and queue in a bank. These are things that we have done. We have had to restructure the FRS twice in the last 4 years. And the latest restructuring happened a few months ago, where we put the taxpayer at the center of our services. Now, the slogan in FRS is, the taxpayer is king. And we are demonstrating that in bringing our services closer and recognizing the peculiar needs of each group of taxpayers. We are collaborating better with other stakeholders, both within Nigeria and outside Nigeria. We interact better. I mean, you can see a demonstration this morning. My executive chairman is there on ground, even though I have to represent him to take this session. We have expanded the tax net indeed. And when I listened to the main presenter, the improvement that has been reported in revenue collection is actually not as a result of overtaxation as been suggested. The improvement we have recorded year on year in recent time result from the combination of the various measures that I have spoken about, including bringing into the tax net persons who had not been paying taxes in Nigeria before. For example, online suppliers of goods and services have started to pay VAT for the last 3 years in Nigeria, even though they are not physically in Nigeria. And we are realizing substantial amount of revenue from there. We have had to be using information obtained by way of exchange of information from other countries to collect taxes in respect of income earned by Nigerian companies outside Nigeria, which was not happening before. These are some of the things that we have done that has combined to improve the revenue collection, not the increase in VAT rate. Of course, increase in VAT has its own impact, but it is not the sole reason. Now, finally, what can we do better? Number one, we have the Presidential Fiscal Policy and Tax Policy Reform Committee rewriting all our laws, simplifying them, and we believe that by the time the new laws are out, the issues of different taxes will have been, at the federal level, will have been addressed. We also see, as a product of that work, a new tax policy document, which is going to drive tax system, not just tax administration in Nigeria, but the whole tax system. And part of what we are doing in FRS is we are further investing in technology. We are further enhancing our system to depend on the use of data. For what we have done now, before now, one of the complaints from manufacturers is that too many reviews, too many audits are happening from the FRS. And we listen to you. In our new structure, you can only get 2 letters from FRS going forward, not like 7 which you used to receive. And the 2 letters will come from your tax officer who reviewing your case, or tax audit if you have to do audit. If you are compliant and you pay your tax to time, you will never get a letter from our debt management office. If you are a compliant taxpayer, you will never receive a letter from our investigation department. And those are the other 2 that will come to you if the need be. Chair, let me close. And let me close on this note. Nigeria is our own. And that means we have expectations from this country. However, for us to realize those expectations, we also have obligations. And one of the obligations is for us to discharge our tax liabilities as and when due. The FRS, the government wants businesses to grow. But government needs revenue to provide the environment for growth. And that is why my closing note is, let us all come round the table, not in an adversarial and an opposing way, but in a cooperative and collaborative way, that we can all put our eyes on the ball and move our country forward.
We are to bring this session to a close in the next 10-15 minutes with our question and responses to this. So I'll start from my left-hand side. Any question?
I've heard everybody talking since morning, but knowing fully well that technology is the way of the day now, we don't have any other way to go. Technology is taking place. I have not seen anybody. We know how critical technology is to manufacturing. So nobody has made mention of technology. That's number one. Number two, taxation. To sustain tax in Nigeria, we have a long way to go, I'm sorry to say, but it's just the truth. When we start with technology, also, we need to look into other section that builds manufacturing. Manufacturing relies solemnly on a lot of things. We're talking about, what's it called? Fuel. For you to run a manufacturing industry, you need power. It is so essential. So if power is not there, now we are faced with fuel scarcity, and the, what's it called? Electricity charges is skyrocketed. So if this thing is eating too much into the manufacturing industry, how do we generate tax? These are the things that will make our people, to say the truth, to want to evade tax. And when people are evading tax because they are not making much of generating good income, profits, let me say profits, not revenue now, because everybody that wants to do business needs profits. So if you are not generating enough of profits, how do we sustain tax?
And finally,
I would suggest to our government that if we are going to sustain tax in Nigeria, the culture of tax, we need to look into all these things, technology most importantly. It is, in fact, I can say that I don't think governments are even looking at a good database for fintech in Nigeria.
So I want to react to the manufacturing paper. It was saying that the Nigerians, their own export was down as at 2019 compared to the global world. So I want to ask, Nigerians do like our product. Our product, I want to attribute this issue to the S.O.N., the Standard Organization of Nigeria, that I don't know whether the compromise or the illusion their functions about the quality of our products that we produce and export. Also, the Manufacturing Organization of Nigeria, I believe they have a quality control unit or department that oversees the quality of products we produce in Nigeria that can compete with other products abroad. That's an issue. So we need to look into that and see that Manufacturing Association of Nigeria equally have a share of the problem that is facing them. So the second one is where, although my principals are here, where he was saying that the revenue increase of FRS in 2019 is attributable to their downfall in their capacity to produce. So I want to advise them, FRS does not tax arbitrarily. There are laws guiding us. And if your operators are classifying costs that are not in line with the tax laws, they will add them back and it will be taxed. So please, the Manufacturing Associations equally have an orientation to that, how they classify their cost items in their books so that they won't be taxed. So it goes for them to handle their areas where they can do more of tax planning, not blaming FRS for overtaxing them.
My first question is, if our tax rate is not low, according to the speakers, then what is actually the major problem? Why is it not reflecting on our GDP? Then again, my suggestion is that if we can have a body, an independent, unbiased body that can go with coercive measure to balance our revenue collected against output on those revenue collected to give us results. In a simple form, you start a business of your own. You know you are putting 1 million and you are expecting 40% of results out of those investments. Will you stand or sleep and watch it being stolen or taken away by some people right in front of you?
No.
I think we've been sleeping for a long time, watching people swirling and taking away our revenue.
Okay.
We joy, we dance, that we collect, and we declare so much money, but it's being swept away by people.
Okay.
We need an independent body that will have a national election to elect people with bias, to look into it and balance it for us.
Okay, my question is of twofold. One, like I heard what the speaker said before the chairman FRS came on board and was talking that they tried to reduce encounter between the taxpayer and the FRS to just 2 checks. That is desk review. And that observation, in the last 3 months, is to the contrary. At least I know I have a client that while they were doing tax audit for some years, another department within the same FRS said they are intelligent. They want to do the same audit that the other people are doing within the same time period. And I was like, I have to write to them. But they did not respond. Why do we have that? Why is there no communication between the unit so that they'll be able to save the taxpayer the time, so that they'll be able to concentrate more on their core activities? And the second one is this. Why is it that a good number of times when you have an encounter with some of these, the FRS officials, they tend to intimidate. They tend to assume that they know virtually everything. I have one that was saying that, oh, they are the interpreter of the law. It is what they perceive to be their understanding that is final. Then they find it very difficult to, you are saying somebody should defend a document. And can you oblige me those documents so that I'll be able to say you should go and reconcile on your own, come up with something? How are you now going to respond very well to their findings?
So, Mr. Adigun, finally.
Yes. So that's just, I want them to look into the activities of their officials so that there will be coordination. Then they should be able to also, like, we are partners in progress.
Thank you very much, Mr. Oluwakayode. Mr. Gbonjubola has noted that, and I'm sure he will respond. The last but not the least, Ogunshola Idowu. Unmute Ogunshola Idowu. Let's have your question, please.
I listened very well to several speakers. I have an observation. I want to draw every one of us to one of the very strong points put across by Dr. Muda. We have to hammer on government the need to reconsider the position of GDP, blank interpretation and application. Definitely, we know the importance of tax to GDP all over the world, but in Nigeria, we are actually interpreting it and applying it blankly. He has given a very good point that while the agriculture has a lot of incentives, the tax from there, the tax revenue from there is always low. Definitely, now to aggregate it with the tax from other sectors and ended up by saying that the tax payment ratio to GDP is low is a misnomer. As a result of this, I know that at the end of this conference, there is going to be a strong position paper. This strong position paper, I suggest that it should go to the government and its tax reform committee so that it will help the nation to grow better in order to meet the objective of this conference.
Finally, Mr. Lawal Monsuru, and that will end the question.
I know that some years ago, the Joint Tax Board, in collaboration with all the with all the Internal Revenue Service of across the states, they had a joint agreement to create TIN number, tax identification number, and thereafter to amalgamate all these this tax identification number, so that wherever the individual living in other states, like Ogun State, if they are living in Abuja and they have any business done in Abuja, the money will be remitted to Ogun State. But it seems that that project is now a shadow of itself. What has been going on, because they created all these desks in every tax station, in all the headquarters of Internal Revenue Service. What is the prospect of this project now? Because the certificate generated that we issue at OJIRS then, if taken to bank, those banks will reject it. They will insist on the one from Federal Inland Revenue Service. Is this thing not going to affect the revenue of all the states? Because all our money are being paid to other states, whereas indigenous living in Ogun State are having transactions in other states in Nigeria, rather than to be remitting to Ogun State through the tax identification number.
I'll do the first one on technology. So we've been through the industrial age, we are now in the information age. So technology and data is very key. The problem is you cannot compete from a national perspective, right? The powerhouses in terms of technology are sitting in the US, in Europe, China, and the shortcut, to circumvent that process is to acquire the technology. The problem, which has been a recurring theme that many of the speakers have already identified, is whether we are competitive. And it's not just looking at the tax incentive environment of the country. You're looking at the infrastructure. So, improving power, rail and transport, as well as security. Now, when you deal with those problems, then you can now attract the investment, as against them taking that technology and moving it to other locations. And if we don't deal with those issues very quickly, we will struggle when the Africa Continental Free Trade Agreement is fully operational. Because the other countries, because they have enhanced and dealt with the issue of ease of doing business, when AFCA kicks in, you become a dumping ground for products. So it's a very important contribution that came from that lady. We need to look at technology, but we cannot look at it in isolation. I will call on Mr. Gbonjubola to speak to the issue of tax rate is not low. What is our problem? And the issue that was raised around desk reviews and audits that people have been encountering different, and the intimidation from tax officers. Over to you, sir.
Thank you very much, Chair, and thanks, colleagues, for those well thought out questions. When we look at issues of tax to GDP, I think it depends on who is looking at it. And that is why we seem to have different interpretations. But the general approach is every sector of the economy, every player, every individual earning income is expected to pay tax. And that is why the simple formula for computing tax to GDP ratio is actual amount of taxes collected over the normal GDP value. And that is why nothing is exempted, nothing is taken away from the GDP, because everyone is expected ordinarily to comply with tax rules. Now, as regards the questions as to repeated audits, even though I don't know the exact facts of the case, but like I said in my little intervention, the reason why the FRS restructured again this year is to ensure that we don't have issues like this again. There's only going to be one office responsible for the tax affairs of a specific taxpayer, including audits. And so you are not going to get letters from different offices, but from the same office. And it is going to be impossible, extremely difficult, if not impossible, for you to get 2 letters from the same office in respect of the same audit, because it's going to be the same person. So we have eliminated that going forward. Now, on issue of the JTB team, I am not competent to speak for the JTB. But the truth is that the JTB team project appear to have somehow become terminated. And that is why each tax authority has resorted to issuing its own TIN. But we are hopeful as part of the reforms that is coming into the tax space by the work of this presidential committee, we are going to be able to unify everything, and each individual and each entity will have just one thing that will be used nationwide. Thank you.
There was a contribution by Mr. Ogunshola Idowu, and he was talking about the paper, well, not paper, your presentation, Dr. Muda, around the tax to GDP ratio, and the fact that there are some sectors that are not contributing. So maybe, you know, in terms of their income, it is low, so they're not contributing. So can there be a paper around those areas on how government can stimulate production? Because if you look at agri, for example, we have neighbors in Ghana doing cocoa. We have another neighbor in Ivory Coast doing cocoa. We have palm oil. You know, those areas are actually what is being taxed in other countries around our region. So what can we do in that area? And I think Mr. Obadimu wants to add to that, because I see him nodding his head as well.
Well, on point of general principle, we need to be careful the way we import economic management models. Whatever strategy we are using in our economic management, we need to localize it. We need to take into account our local peculiarities. Unless we do that, we may be taking some wrong steps. For instance, we have been advised to go and float the currency. It's not an entirely bad idea, but it's an idea that requires some modification. We can all see the consequences of the volatility of the exchange rates on the economy, particularly from the point of view of planning, uncertainty, investors' confidence. We have been advised that we should continue to increase interest rates, possibly until the interest rate matches the inflation rate. You know, that will be a disaster. Because how do you want to invest in agriculture, invest in mining, invest in real estate with an interest rate of 30%, 35%? That cannot happen. So there are a lot of things that come from IMF, World Bank, that we need to modify. And even in this tax, when IMF is talking about tax, they're always talking about tax to GDP ratio. So that is why I was talking about our having to interrogate some of these metrics to ensure that we incorporate our local peculiarities. The structure of our economy is not the same thing as the structure of these other economies. So it's very important from a policy point of view. The agri sector is not just generating revenue, it's consuming revenue, because you have to subsidize them. All the irrigation projects, all sorts of subsidy fertilizer, these things are not being paid for. You just do the irrigation, the farmers go there, they farm, and they go. So it's even negative tax already. And you have a sector like ICT, like oil and gas, contributing some 7%, 9%, contributing almost 80% of the revenue. That is the nature of this economy. So we need to capture that so that we don't begin to carry wrong conclusions about the economy, about whether we are paying enough tax, we are not paying enough tax. We need to address these fundamentals. And that may require maybe some further research, just as the person has said. Thank you.
Dr. Yusuf has really said everything. Let me just put a final word on it. We keep saying it. We know it, that there is a need to diversify our revenue generating base. We need to. The more we are able to do that and strengthen activities and growth in all our productive areas, the more people we're able to employ, the more taxes we're able to collect, both from corporates and individuals. It is not rocket science, we all know that. And the second point is that I don't want to see a situation where if you are diligent in paying your taxes, the reward you get is to be taxed more under one guise or another. That shouldn't be the reward for people who are diligent in paying taxes. So rather than concentrate on getting more from the few that are bringing the money in, we should diversify our income generating base so that we could have more from all available sources. And one last point. I hope we will get to a point, because this is a professional setting, this is a professional conference where a lot of money has been spent, a lot of resources have been put in place to organize. If our public sector officials could take more time to listen to these things that are being said, rather than just say a few things for 5 minutes and leave immediately after. It does not do justice to all the efforts that have been put in. Thank you very much.
Thank you. I'll take 1 minute contribution. Very quick last words, Dr. Chijioke.
Yes, I want to react to what Muda has been talking about, importation of models. When I was speaking, I mentioned what the countries I considered our contemporaries did, countries in oil and gas, that CIT 0, I said so, PAYE 0, and some other payments that had to do with individuals 0. But they went to major sectors, oil and gas. If you make your profit, we're taking 55% of it. Mining, if you make your profit, we're taking so percent of it. These people also, and including many other African countries, already said 0 to VAT to certain categories. So it's not even as if that we are taking a whole chunk of taxes without backing out the informal sector, which is what is considered. All these other countries also have backed out informal sectors when they calculated their tax to GDP ratio. So we need to look at what people who are succeeding are doing. And by the time we reduce burden on people and businesses, you see that they will do better. All this inflation rate we're talking about will come down because there are people who are doing major things, having revenue from our oil and from our mining. Let them get part of that income, part of that revenue, and let us take them into tax. So what we're trying to do is just to grow manufacturing, reduce burden on individuals so that everybody will have a good standard of living. Thank you very much.
All right, last words from Mr. Alonge.
All right, so on a final note, manufacturing is very critical to the development of any economy, and if a nation chooses to pay lip service to this, there's going to be a dire consequence for it. I'll take a cue from what happened in the 70s and the 80s. some of the problems we're faced with right now as a result of bad economic policies that drove out many of the manufacturing outfits out of Nigeria. So right now, whatever gains we have made in the past, 1 decade or 2, we must make sure that we are deliberate about the policies that we are bringing so that we don't go back to the bad times we have had before. If we want to stop insecurity, we want to create employment, all of these things have their answers rooted in the manufacturing sector. So we are appealing to the government and every other state actors to please make sure that policies that are favorable in terms of taxes are the ones that are specifically directed at the manufacturing sector, because we are a critical sector. And of course, revenues that are made from this sector should also be used, to develop infrastructure so that manufacturers will have to, worry less about providing some of these things that, the nations, the government is supposed to provide. Manufacturers are not supposed to bother themselves about road and a whole lot of critical infrastructures, powers, water, and the likes. If government can take the money and use it judiciously, let it really affect the sectors that matter the most. Thank you so much.
Thank you very much. With that, I hand over to the MC.
Please, a round of applause for this session. We've done wonderfully well